Well, there are several opportunities that I see, all of which have challenges. Um, I am a fairly large holder of U.S. one-year treasuries. I am among those who believe it's better to lose 5% than to lose 15%. And so I'm holding a lot of liquidity. I'm very afraid that we will experience a crisis of confidence, and that crisis of confidence will yield an event like 2008. There's no guarantee, but I think the possibility is high enough that it's a contingency that I have to insure against. The most liquid market on the planet is the US Treasury market, and the 1 years at 4% relative to any other duration seem attractive to me. The other thing I'm doing is I'm celebrating my retirement at age 69 by starting yet another bank. The credit spreads between federally insured deposits and other forms of longer term credits is as broad as I've ever seen it in my life. And I can't help but attempt to take advantage of that. I, too, and this will get me a lot of hate probably from your listeners, I'm a reasonably large bullion holder. And one would wonder, if I had an independent financial advisor, why I hold bullion. I'm the largest shareholder of Sprott, which theoretically should do very well in a time of higher gold prices. But at age 69, gold helps me sleep well. And I'm in the ironic position of owning a fair bit of gold and actually hoping that the price goes down. You see, if the gold price ran from US, 1650 to 22 or 2300, that wouldn't prompt an action on my behalf. I wouldn't sell gold. But if gold fell from 1650 to 1500, I'd buy a lot of gold. So I'm in the strange place where my motivation with regards to gold, given my nervousness about other forms of assets, is such that I would rather the price go lower so that I could buy more, rather than the price go up, which wouldn't condition me to sell any. I guess the last thing I'm doing, and your listeners shouldn't do this, we're in a real risk-off environment, and risky environments, and there's no riskier asset class in the world than junior mining stocks. The junior mining stocks, the sort of 150 or 200 that are viable worldwide, out of the 3,000 that pretend, are having a real capital raising crisis. And so selectively, I'm trying to go into a risk-off market and provide capital where no one else will do it, on terms that are reminiscent of the terms that I was able to receive 5 years ago. So I'm actively looking for opportunities to deploy capital among very, very, very high quality juniors, in the absence of any other capital provider. Well, simply because of the strength of the dollar, I would suggest. I think that investors' conditioned response over the last 40 years has been that the US dollar is the risk-off asset, irrespective of the arithmetic around it. It's important to know that 20 and 25 years ago, investors could park money in US treasuries and get a positive real yield against US inflation. I don't think yet that the reality of the arithmetic around the US treasury market has impacted very many investors, or those same investors are so afraid of every other asset class on the planet that, like me, they prefer to lose 5% real as opposed to 15% real. The circumstance that we find ourselves in today reminds me of two prior circumstances that I personally lived through. One was 1975, where the US Fed raised nominal interest rates in the United States, greatly strengthened the US dollar, and cut the gold price from $200 to $100. The resulting damage in the US economy and the political reality of a democracy meant that towards the end of 1975, the Fed lost their nerve and backed off. And when that happened, gold went on a 6-year romp from $100 to $850. Similarly, at the end of 2001, the beginning of 2002, we had a circumstance where US interest rates rose, and gold was doing well in every currency in the world with the sole exception of the US dollar. Again, the Fed had to reverse course. And when the Fed reversed course, gold did very, very, very well. I'm not suggesting that past has to be prologue. I'm not suggesting that any of your listeners have an overexposure to bullion. I know lots of people that are 100% involved in bullion, and I think that's madness. But I also think that having no exposure to bullion, if you're a saver, if you have some portfolio to protect, is a necessity. Make no mistake, a negative real interest rate was described by Franz Pick as a certificate of guaranteed confiscation. It is not good arithmetic. It seems as though there's enough residual strength in the U.S. economy, and particularly that the global narrative is that the U.S. economy is a strong and functioning community. It would seem that the Fed can continue to allow interest rates to rise gradually in the near term. And if the interest rate differential between the United States and Japan, the United States and Australia, the United States and the pound, the United States and the euro, never mind the United States versus emerging markets, which are basically, with regards to liquidity, uninvestable. To the extent that that continues, the US dollar strength continues until it doesn't. You may remember yourself concern in credit markets beginning in 2006 about the state of sub-investment grade bonds in the United States and real estate securities in the United States. I remember myself driving to Los Angeles airport, seeing a billboard on the right side of the highway that said, borrow 125% of the value of your house. Bad credit, okay. I'm not a real estate guy, but I looked at that sign and said, I don't like the sound of this. Did I do anything about it? No. Did anybody else for the 2 years between 2006, 2008? No. The trend in motion continued until it didn't. But when it didn't, the disruption was fairly violent. What I learned from that is to look at today's circumstance as an example, and any sub-investment grades credit that I myself haven't structured or that wasn't structured by Sprott, I've sold.
Right. Okay.
Maybe I miss out in 3 years opportunity cost with regards to excess interest. I'm okay with that. Foregone yield as opposed to destruction of principal is something that at age 69, I'm very much in favor of.